talking a little bit on standardized models and internal models. Now, these are the kind of terminologies which most of us have come across in literature, or many times it comes up in, let's say, financial dailies or newspapers as well, which talks at least briefly about that this is the kind of standardized model which has been recommended. So maybe you can have specific news reports which can talk at least this in brief. So let's try to understand what they are, and also let's try to see how exactly regulators are trying to bring in uniformity or more of stringent approach to the way in which these models are getting applied. Now, why do you require these models? Firstly, these models are required to measure the amount of capital which is required to be allocated by the bank. Now, when we say standardized models, these are the ones which are recommended by the Basel Committee. So think of these more of ones which are driven by regulatory guidelines or regulatory standards. And then we have internal models, which are developed by banks themselves. So that way, a bank can have their own internal team of financial analysts plus financial engineers who can develop these kind of models for their consumption. Now, let's walk through a bit of timeline on the usage of either of these two above, and I've given how exactly the progression has happened across time. So that gives us further motivation to see how these models have evolved, rather how these, not just their evolvement, but then how exactly the banking landscape has also evolved to adopt these models. So starting with the first one, so models for credit risk were introduced at the time of Basel I. They were standardized models developed by BCBS. And there's a reason as to why these standardized models were prescribed by BCBS at that point in time, because they wanted banks to have a uniform approach to the way in which they do their risk calculations, i.e., the simple point which BCBS was trying to put across is that if the banks are looking at same portfolios, then they should be able to arrive at the same risk capital. And that's why they prescribed standardized models, which had to be applied for credit risk. Now, under the market risk amendment, which we saw in one of the previous slides as well, now banks were allowed to use internal models as well as standardized models for market risk capital. However, the banks had to do one thing. They had to ensure that the internal models had to satisfy all of the regulatory requirements. Basel II allowed usage of internal models for credit and operational risk, because then, as we saw around the time of Basel III, operational risk is something which banks started considering as a part of the capital. Rather, regulators mentioned that this is a very, very important part of risk, and we want you to incorporate that as a part of capital. So that's why we have this operational risk part. Now, post the global financial crisis, so you can imagine that the GFC was like a change of an era, I would say, because then the way in which risk was perceived prior to GFC vis-a-vis risk was perceived after that, that is drastically different. So I can say with certain level of confidence that prior to the GFC hitting all of us, risk management was seen more from a compliance perspective. So it can be thought of as if risk was thought like a cost center. So sure, I mean, banks used to say, all right, we have this risk team within place, and this is in line with this particular regulation. But then post GFC, banks realized that it's very, very important to have risk involved in all of their strategic decision making as well. And that's why you'll observe that nowadays risk is not treated as a cost center. Sure, it's not a revenue adding function as such, but then we treat risk as something which is strategically important. And that's why the visibility of risk has drastically increased post GFC. So post GFC, regulations have become very, very stringent as well. So for operational risk, standardized models are to be used. And for market and credit risk, standardized models to be used for market and credit. However, banks will use internal models only if they receive regulatory approval. Also, regulators generally do not support the idea of regulatory arbitrage. So banks are not allowed to capitalize the benefits of regulatory arbitrage by choosing between, let's say, standardized or internal models. So what do you mean by regulatory arbitrage? Let's say if if I look at a certain position and it is generating a certain amount of capital through the standardized approach. So let's say I call that capital amount as, let's say, C1. And then I use an internal model for the same position and I try to calculate it, and that gives the amount of C2. And let's say C1 is greater than C2. So then I could have an incentive to use internal models for that particular position, because then that is freeing up my capital requirement. But then this is something which is not supported by regulators. They say that we don't want you to capitalize on this because the idea is not about, so sure, profitability for banks is important, but then from a regulatory point of view, it's important that banks are remain stable and these kind of regulatory arbitrages. Sure, I mean the short-term banks are able to free up capital, but that also exposes them to a considerable amount of risk in the future. So that's why regulators do not support this idea of regulatory arbitrage. Now, by 2027, the regulatory capital would be driven by a relation given as below. So it's the maximum of IMC, which is the capital as per internal model, or 72.5% of SMC, which is capital as per the standardized model. And as I mentioned earlier as well, regulators want banks to be very, very well capitalized so that no matter what, the bank should be robust enough to tide over any kind of systemic stress and they should continue as a going concern, i.e., not to deposit on their commitments and continue their business as usual.